Today we're talking about something the Federal Reserve and the Obama administration don't want you to think about. We'll make the case that the Federal Reserve is a Ponzi scheme on today's economists' militia. You all know what a Ponzi scheme is. Named after famous 1930s financial crook Charles Ponzi, the Ponzi swindle is one where people put their money into a fake business or investment. They often don't know it's not real. They receive interest payments on their investment, but since there's no real investment, the interest payments are really money taken from new investors. As more new people come in and expect payment, the fraudster has to find more and more and more people to invest. Ultimately, the fraud becomes unsustainable and the entire thing just crumbles. Bernie Madoff made off with an estimated $64.8 billion in one of the largest examples of a Ponzi scheme. $65 billion sounds like a whole lot of money, doesn't it? The Federal Reserve System has very much become a Ponzi scheme, and it's a lot bigger than $65 billion. Here's why. The normal role of the Fed is to authorize the creation of new Federal Reserve notes, the currency of the U.S. The Treasury Department prints what the Fed tells them to, and the Fed puts the money into circulation. The Fed also decides how much money comes out of circulation. This means they can either flood the world with money or limit the flow of U.S. dollars. That's their job. The process of regulating that flow of actual cash creates an elastic currency. The government floats bonds to pay the Federal Reserve for creating this currency. They sell those bonds to individuals, companies, and foreign governments. It's well known that the Chinese and the Japanese are huge investors in Treasury bonds. Well, now you know why Treasury bonds exist. Of course, Treasuries are also floated to fund other government operations. When the government spends more than it takes in, it's called deficit spending. That deficit is covered by Treasury bonds. In 2009, that amounted to nearly $2.1 trillion in Treasury bonds, which is nearly 3 times the volume of bonds from 2008. Now, here's the thing the Obama administration doesn't want you to know. In 2009, the Federal Reserve bought more than 80% of the Treasury bonds floated for the year. What does that mean? The Treasury can't find people or companies or countries to buy the bonds that fund the federal budget, so the Federal Reserve Bank buys them. But the Federal Reserve authorizes the money that is printed to buy the bonds that are used to pay for the money the Fed prints, so it's one great big circle. When I say great big circle, think toilet. Ponzi's swindle was worth about $200 million of today's dollars. Bernie Madoff's Ponzi scheme was $65 billion. The Fed's Ponzi scheme is more than $2 trillion. So, why is it a Ponzi scheme? The government can't fund itself, so it has the bank it created fund it. The bank makes the money used to buy the bonds, so it can never run out of money. Of course, eventually the bonds and the money become worthless. So why does the Fed buy the bonds that aren't sold at auction? The bonds are auctioned at a specific rate, and when investors don't buy, well, it's because the rate isn't high enough to justify the risk in the investment. But rather than let free market dynamics tell us how risky our federal budget is, we hide that information inside our central bank. In this way, the Fed keeps the economy afloat. If they stopped buying the bonds, the bond interest rate would skyrocket. That's because the true risk of U.S. government debt, the true risk of the U.S. federal budget, is far greater than the current interest rate on those notes. The Fed keeps the rate in check by buying any note which doesn't sell at auction. In a normal free market system, those Treasury bond interest rates would rise until they became attractive enough to buy. The result? Much higher interest rates on government debt would cause the U.S. federal budget deficit to skyrocket because we have to pay for those interest payments, and that's going to cause every other interest rate to skyrocket. The two big interest rates, mortgage rates and short-term commercial paper, would rise rapidly, which is another way of saying they'd skyrocket. And the end result would be that the housing market would collapse, and nearly every business dependent on any line of credit or asset-based lending system would freeze up. And that's virtually all of them. So, this Ponzi scheme is keeping the entire country afloat. Now, of course, things like financial restraint and reduced spending would also keep the country afloat. But those aren't exactly strong suits of politicians, are they? Tell truth to power. Hear the real story. Think for yourself. Join the conversation at econmilitia.com. Take back your inalienable rights.